Finance 310, Chapter 13, Risk and Capital Budgeting. So in this chapter, we want to talk a little bit about what are common measures of risk, how can we use them, and how can we try to account for risk in our capital budgeting decision. Again, you should have covered this material in 210 a little bit, but we probably didn't go as far as we will go in this class. I'll make sure you calculate everything in this class, and you can calculate everything, which is not something, typically at least if you took the class with me in 210, that we covered. Uh, okay, so before I start though, I want to talk about a concept, the concept called risk aversion. And while risk aversion, like in practice, we're not really going to use that. I think it's really important to understand the concept in order to understand finance better. Okay, so what is risk aversion? Well, I think it's easier to start with an example. Okay, suppose that I offer you to participate in one of these three lotteries. Okay, so I'll flip a coin. If I get head, I'll give you $100. That's lottery one. And if I get tail, you give me 50 cents. Second lottery, same thing, but on a head, I give you 200, and on a tail, you give me 100. Lottery three, same thing, but on a head, I give you 20,000, and on a tail, you give me $10,000. If I ask you, which one of these lottery would you prefer? Which one of these three lotteries would you be willing to participate in? Okay. And maybe you would say, I wouldn't participate in any of these. Maybe I don't like any of these. What we've noticed, and economists have noticed, is that if we ask people to choose one of these three lotteries, the vast majority of people will choose lottery one. Okay. A really small amount of people will choose lottery two or lottery three. Uh, and that is actually a pretty big problem from an economic point of view. Okay, economists find this really, really weird. Why? Well, because the expected payoff, the average payoff, and I know we didn't talk about how to calculate the expected payoff for a lottery yet, but the expected payoff for the first lottery is just $49.5. So if you participate in the first lottery, you'll get $49.5 on average, right? Uh, in truth, you'll either get $100 or you'll pay me 50 cents. The expected payoff of the second lottery is $50, and the expected payoff of lottery three is $5,000. So economists think, well, if you're rational, you should try to maximize your payoff, and you should pick the lottery that gives you the highest expected payoff. Okay, what is happening here? I'll just go back to the previous slide, if you don't mind. Okay, what is happening here? What's happening here is that most people are risk averse. Again, in a class, I would make you raise your hand and we could see who chooses which of these lotteries. But most people will pick lottery one because the risk of losing, the amount that you lose if you do end up losing, is really low. Okay. In lottery three, the amount that you lose if you lose a lottery is quite high. Okay. And for this reason, many people will not pick lottery three and will prefer lottery one. But again, this is weird. The expected payoff of lottery three is much, much higher than the other two lotteries. You should be willing to participate in lottery three. Um, and so that's it. We call this phenomenon risk aversion. People are adverse to negative impact, to negative things. Losing $1,000 feels worse than gaining $1,000. Okay, and that concept is the concept of risk aversion. Okay, most people are risk averse. Most investors, most managers are risk averse. Usually in my class, I'm always surprised. Young people should be the most risk seeking, the least risk averse people. And when I teach investment courses, right, a lot of people are like, I am not, I do not like risk. I want to invest my money in a safe way. So it's pretty common, and we see it empirically all the time. Okay. Um, to distinguish here, risk neutral individual only care about the expected payoff of a policy or of a lottery. So if you were risk neutral, you would have picked lottery 3, because you just care about the expected payoff, and the lottery with the highest expected payoff was lottery 3. Risk-averse individuals tend to prefer outcome or lotteries with low uncertainty. So there's not a lot of risk, there's not a lot of dispersion of the potential outcome, right? And especially there's not a lot of negative outcomes. Those of you who chose lottery 1, you're probably risk averse, right? You don't like this potential of losing $100 or $10,000 from lottery 2 and 3. So you're risk averse and you choose this one here. Some individual maybe, although they're relatively rare, risk seeking. Those are individuals who actually tend to just like risk or uncertainty just for the fun of it, right? It's just fun when there's uncertainty. I can lose 10,000 or I can win 20,000. That's great just by its own value, right? By the fact that there's some uncertainty that creates value or fun or interest for me. Okay, and those are people who are risk seeking. Um, the I'm not going to discuss a lot of the theory behind risk aversion, but what is important to understand is that this concept of risk aversion leads to a really important phenomenon in the real world, right? Uh, if you have riskier investment, they should yield higher rate of return because people are risk averse. So to convince people to bear more risk, we need to give them a higher rate of return. Okay, so for example, if you go look right now, the interest rate on short-term bond and the interest rate on long-term bonds, normally short-term bonds have a much lower interest rate than long-term bonds. Why? Well, because of risk, right? Because people are risk averse and short-term securities are much, much more likely to see the payments back, to get the payment back. With long-term securities, you're less likely to see the payment or get the payment back. For example, imagine a 30-day bond or a 30-year bond. It's really unlikely if you've looked at the financial statement, if you know what the company is doing, that a company will go bankrupt in the next 30 days. It's a lot more difficult to forecast if the company will still be open and operating and a going concern in 30 years from now, right? So this risk aversion means that short-term securities usually have lower interest rate than long-term security. The average rate of return on stock is higher than the average rate of return of bonds. Why? Again, because of risk aversion. People are risk averse. Bonds are safer from the investor's point of view compared to stocks. So they pay a lower interest rate because they are safer, and people want to be compensated if they decide to bear more risk. Okay, historically, but not in recent history or in recent times, right? The average return on value stock has been higher than the average return on growth stock. Why? Okay, well, value stocks tend to be stocks that are not really doing well right now, that people are scared, right? They're going to be in trouble, they might not survive, or they might not have a really bright future. So these are value stock, right? And they're a little bit scary, okay? Growth stock are stocks that have had in the past, in the recent past, a pretty good trend of growth, right? So these stocks are less risky because we know that they have been traditionally in the past growing rapidly, okay? And again, the reason for the difference is risk aversion, okay? One set of stock might be riskier than the other set of stock. Um, Okay, so super important. Understand the basic of what risk aversion is, what it means, right? People are scared or do not like risk. They want to be compensated for bearing risk, so we need to give them a higher return if we're going to make them bear risk. Okay, and that's it. That's it for this video.